6-19, and we have a person named Lynn Parsons who is looking at two different bond alternatives. Both bonds have $1,000 par values and 13% coupon interest rates and pay annual interest, so annual compounding. Bond A has 5 years to maturity and Bond B has 15 years to maturity. And so in Part A, we are asked to calculate the present value of Bond A if the required rate of return is 10, 13, or 16%. So the required rate of return is something that would be kind of specific to the investor and in terms of how much they would be willing to pay for the bond with its particular characteristics or terms. So here we are going to utilize, again, the present value function in Excel. And the rate, again, remember, is always the required rate, or sometimes called the discount rate or cost of capital. So in this case, for the first part, it's 10%, so 0.10. Annual compounding, so we don't need to adjust the rate at all. Number of periods is for Bond A 5 years to maturity. And our payment is the $1,000 par value times the coupon rate. In this case, for Bond A and B both, they have 13% coupon rates. So that's 1,000 times 0.13. And the future value is just the par value. So we'll get the investor, in this case Lynn, would get $1,000 if she were to hold the bond to maturity. She would get that her $1,000 investment back at maturity if she paid par value, or if she paid above or below par value, which is what we're going to calculate now. So with that, in this case, this first option, utilizing a 10% required rate, the value of the bond would be $1,113 and 72 cents. So she'd be paying a premium over par to purchase the bond. And for the next couple, we can just simply change the required rate. So if we were to base the potential purchase on a 13% required rate of return, then that would give us, as we would expect, 13% required rate versus 13% coupon rate. It's always going to give us a value of par. And now we are looking at paying a 16% or requiring 16% rate of return. And in this case, we would be paying a discount, so 901.77. And this should make sense in that if we're looking at or comparing the coupon rate of 13% versus the required rate, just comparing those rates, we should know whether or not we're going to have to pay a premium or a discount. So we said a minute ago that knowing that the required rate is 13% and having a 13% coupon rate, we know that if they're equal, the value of the bond is going to be par, in this case $1,000. Now what if we have a required rate that's less than the coupon rate? So in this case 10%, and the coupon rate's 13%. Well, if we're only requiring 10%, but yet we would get paid 13%, then the value of the bond is going to be higher than par. The price of the bond would be bid up in order to essentially get a higher rate of return than what is even required in the market. And the opposite is true if the required rate is higher than what the bond is paying. So if the required rate is 16 and the bond's only paying 13, then investors aren't going to be willing to pay par for a bond that is paying a lower coupon rate than what they desire. So just knowing these facts with the coupon rate and the required rates, we should already know before we start the problem whether or not the value is going to be a premium at par or a potential discount. So the value of bond B, if the required rate is 10%, so a couple things here to change. We'll put the required rate back at 10%, and remember that bond B has a 15-year maturity, so we just need to change the number of periods to 15. And that'll give us the value of bond B at 10%, so $12.28 and 18 cents. And now if we have a required rate of 13%, now we can just change the rates. And of course, that is, again, as we would expect, $1,000, but here it is, proof of with the Excel function. And at 16%, again, we should be expecting discount here, and we have $832.74.